I'm Ron DeLegge with the ETF Guide. It's great to see you again. Hope your summer's going well. I've got some things I want to share with you on today's episode, so let's get right to it. Beginning with the most important factor, the single most important factor in shaping stock prices is public psychology. And that was true 50 years ago, and it's still true today. No matter how much technology, algorithms, or whatever else gets embedded into financial markets, it will still never fully extract human behavior from the equation. And we see here the Fear and Greed Index from CNN, currently at a neutral reading. Yes, these are the dog days of summer, so no surprises here. Now, sentiment readings are one thing, but stock prices and stock performance are something else, and they are a leading indicator. That's stock prices and stock performance. Sentiment indicators are not leading indicators, by the way. They're interesting to look at. But in this chart, we see the three big U.S. equity benchmarks as tracked by ETFs, triple Qs tracking the NASDAQ 100, SPY linked to the S&P 500, and DIA tracking the Dow 30, or also known as the Dow Industrials. And you can see here that from this year-to-date chart, that means from 2023, all the way through the market close of August 25th, we see that the triple Qs are winning handedly, outperforming. Of course, that heavy technology exposure has been a great asset thus far in 2023. And of course, our ETF battle judge, Dave Krensis, a big fan of the NASDAQ 100, who says and reminds us all the time, constantly, that he believes that the NASDAQ 100 is the next generation S&P 500. And it's certainly hard to argue with that awesome performance that we're seeing from the triple Qs. In terms of S&P 500 industry sector performance, there's 11 industry groups, and if we slice them up like a Chicago pizza or New York pizza or whatever your favorite style pizza is, you're going to see there's 11 different options. And of these 11 sectors, 8 are up and 3 are down thus far in 2023. And 8 is more than 3 last time I checked, and that favors the bulls. The bulls are clearly in charge in terms of bullish equity performance, and that's reflected here, especially in those top 3 sectors. XLC, XLK, and XLY are the ETFs linked to those top 3 performers: communication services, technology, and consumer discretionary. And if you look at the actual representation of the overall S&P 500, you'll see that these 3 sectors alone account for almost half of the overall equity exposure for the S&P 500. So to say that these 3 sectors are an influence on the overall S&P 500's performance and behavior, I'd say that's an understatement. Our next chart takes a look at something I've been talking with you about for the past several weeks, and that is that bonds are not a margin of safety asset. Now, here's a look at the total U.S. bond market, also known as the AG. And if we look at the Vanguard Total U.S. Bond ETF, which tracks the AG, ticker symbol BND, it's down more than 2% this month alone. And that's a feat that has happened just 5 times since 1990. We live in historical times, if you haven't noticed. But the translation is this: bonds, all bonds, including government and municipal bonds, can and do lose value. And as such, they don't meet the minimum standards of safety for your margin of safety bucket. And I've talked about this many times on this particular channel, and I will continue to evangelize that message. And it's not that I've got something against bonds. Bonds are fine. They have a place in your portfolio, but it's not inside your portfolio's margin of safety bucket. We'll talk more about that in a second. Let's take a look at our next chart, and this one really gives us a taste of what the bond market thinks about Fed Chairman Powell's latest Jackson Hole speech. And the bond market right now is pricing a 57% chance of another interest rate hike of at least 0.25% or greater at the very next Fed meeting on November 1st. And 57% is more than 50%. That's more than half for the statisticians watching. Yeah, I know. 99% of all statistics only tell us 49% of the story, 100% of the time. But 57 is more than 50. It's also more than 49. But anyway, that's why you have me, right? To explain the 51% of the story that the stats don't cover. This is from the CME group, in case you're wondering, and we'll update you on this in the future. But this is becoming a real problem. The higher interest rates is, if you take a look at national debt, and I should remind our audience that besides national debt, U.S. taxpayers face nearly $80 trillion in long-term unfunded obligations that are tied to Medicare and Social Security. Now, here's a chart from the Manhattan Institute, which shows this disastrous impact of rising interest rates in 1% increments. I repeat to our audience, dramatically higher tax rates are the only way out of this. And that means if your retirement plan says or shows you being in a lower tax bracket in retirement, then I'd say you probably need a new retirement plan, because that's not what I believe. That's not what you should believe. And that's certainly not going to be the retirement that millions of investors today face. Maybe that was true of previous generations, low tax brackets in retirement, but not our generation. These are different times. And this is a pretty scary chart. This is a chart, by the way, and a trend that's not going to be fixed anytime soon. I saw another chart, by the way, which I don't have here, but it showed how much the U.S. government has spent in the past 3 years alone. And you know how much money they've spent? $25 trillion. $25 trillion with a T. That's a lot of bananas. And it also means that runaway government spending is accelerating. It's not decelerating, and it's going in the wrong way. And with higher interest rates, it's a deadly, deadly combination. And it's no wonder my favorite economist, the great Milton Friedman, reminded us that if you put the U.S. government or any federal government in charge of the Sahara Desert in 5 years, there'd be a shortage of sand. Well, I can tell you he wasn't wrong. And thankfully, they haven't yet invaded the Sahara, so there's plenty of sand last time I checked. Here's a chart that shows the problem with housing inflation. Well, to put it frank, it's up massively. And so are financing costs. What would a monthly mortgage payment look like for a new home buyer in the U.S. based upon meeting existing home prices today, and then an average 30-year fixed-rate mortgage, assuming 20% down payment? Well, here's a mind-bending chart to feed your sick curiosities. And as you can see, $2,322 would be the new monthly payment, which is a lot more than what it was just a year or 2 years or even 3 years ago. And it's definitely one of the reasons why many people are being priced out of the real estate market. Getting back to your investing framework, because this is important to always invest with an adequate cushion and margin of safety. You can break down your total portfolio in 3 buckets. Now, this is not the tax buckets that I sometimes illustrate. This is the buckets in terms of how your investments are positioned. You've got your core portfolio, your non-core, and then your margin of safety. You always start with safety first. You don't jump out of an airplane and then ask, is my parachute ready? No, you do the safety check. You make sure the parachute's on. Well, guess what? With investing, it's the exact same. You first start by calculating the size of your portfolio's margin of safety. And I can tell you right now, those of you that are not doing it this way, you're cruising for a bruising. And as you approach retirement, your margin of safety will be larger in size compared to the investor who is still in the accumulation phase. Now, those are just some general guidelines. Why do I say that? Because as you retire, what ends up happening is you're getting older. Well, we're all getting older. But when we retire, our window, our investment time horizon is actually compressing. It's getting smaller. And that means we cannot afford to take sizable or huge setbacks, financially speaking, because markets are in a bad mood or acting up. Plus, don't forget, we're also taking out retirement distributions. So the combination of retirement distributions plus bad markets can actually cause you to deplete your retirement assets, run out of money, which would be the worst possible scenario. Of course, dying too soon would be pretty bad, but getting old and not having enough money to sustain your lifestyle, that's a big problem. So having an adequate cushion or margin of safety, you can prevent that by implementing that margin of safety. But where do you go? How do you start? Where do you begin with this? Well, guess what? I built an entire tool called the Margin of Safety tool, which will help you to do three things: calculate, implement, and then monitor your portfolio's margin of safety. So go over to etfguide.com, get started. I encourage all of our viewers to take advantage of this tool and take advantage, too, of favorable markets. In terms of market timing, when is the best time to implement your portfolio's margin of safety? Well, you don't want to do it. The least optimal time is when it's hailing cannonballs, right? When the house is on fire. Well, you want to do this before the house catches fire. Hopefully the house never catches fire, but if it does, you want to make sure that you've got the protection ahead of time. So before the market starts sinking and start acting up and start doing things that we don't expect it to do, you have your margin of safety implemented. And then, of course, before you can implement it, you have to calculate it and monitor it. So anyway, get started at etfguide.com. Also, you can join our free membership club. We've got lots of wonderful services and tools to help you stay on top of your investments. I do online courses. We've got live events. We did a couple of retirement planning webinars at no charge. But to get all of these benefits, you got to go over to etfguide.com and become a member. And then finally, check out my book, Habits of the Investing Greats. It's available at amazon.com. It's a 4-star reader-rated book, and I think it's just another fantastic tool. Put it on your summer reading list, and I think it will definitely help you to have the right mindset in terms of preparing your investments for not just now, but what's ahead. As I like to say, like Cool Hand Luke, you got to get your mind right. And before you can get your money right, you first got to get your mind right. So hopefully we've done that, at least in a small way, on this episode. And again, thanks for watching. Don't forget to subscribe to ETF Guide TV. Hit me up in the comments section below. Let me know how you're enjoying some of our original programs, as well as the financial tools that we're building at etfguide.com. We'll see you soon.